I mean, basically now I'm kind of starting to use these research meetings as a tutorial on different areas of research. Last week I talked about FX markets, how to quote FX markets, certain basic concepts of FX markets like carry trades, covered interest rate parity, forward, uncovered interest rate parity, and so on. But today I thought I'd talk about Excel, because obviously Excel is kind of like the workhorse of a lot of the analysis that we do. And so I'll kind of talk about some general principles and how best to use Excel, things that work for me, and some formulas and such that I tend to use quite often. And then with time, when you start to use all of these things, it makes you very fast with being able to put together analysis, which is the point is to be fast and accurate when you're putting together analysis. So what I'll do is I'll share the screen, and then I'll kind of go through some stuff, and then feel free to interject if you have any questions. So here we go. So hopefully you can see the screen. So hopefully everyone can see my Excel screen. So first some kind of general principles on how best to use Excel. The first thing is let me just write down like notes here. I'm going to share this spreadsheet with everyone afterwards. So the first rule is never use the mouse. So essentially, if you use the mouse, first of all, it takes your hand away from the keyboard, which slows you down. Secondly, it tends to be less accurate, because if you're going here, there, it's just much less accurate. So what you have to do is you have to try to learn as many short keys as you can. So some basic ones are obviously there's the arrow keys, on the keyboard, up, down, left, right. And then if you press Control, and I'm talking about PCs here, Windows PCs, they're not, I'm not talking about Macs, which are slightly different. But if you press Control Home, that takes you to the top left cell. And that's quite important because often you get lost in the middle of a worksheet and you need to quickly go back to the beginning. So Control Home is an important short key. So use short keys. So sort of Control Home is an important one. And then also when you have, this is just a random number generator that Excel has. Now, if you want to get to the bottom of this, you can either do page down, or if you press Control and the down, that will make you jump right to the bottom. And Control up, that makes you jump to the top. And so that kind of allows you to move around very quickly. So Control up, down, left, right. And then the other one is if you have an extra worksheet, like sheet 2 here, if you press Control page down, Control page up, that goes between worksheets. And so if you had another one, Control page down, down, Control page up, Control page up. So those are some kind of general. So those are some kind of general points there. The second thing in terms of rules are. Second rule is never hard code anything. Never hard code. And what that means is, let's say I have a set of values here. Whoops, let me just do that again. I've got a set of values here and here, and then. So I've got these two, just values that I've downloaded from somewhere. So these are two series. And then I kind of do something like, I do some kind of manipulation. So I do that times that, and I kind of copy that down. I should also add you should all probably know this, but Control V is paste. Let me do C. Control V is paste. So that's copy, that's paste. So, let's say we have these values. Now, what people do is they might, and you want to, let me just sort of say, look, these are, let's say I want to put the first and the fourth value into a table. So some people might say, okay, I'll just copy and I'll paste special the value there. And I'll do copy and I'll paste special the value there. So by paste special, what I mean is you go to copy, and then what some people do is they go to paste special values. And so what you have here is you just have the values there. You can see you should never do that. When you have a table, it should always be linked by formula to wherever you're going. And the reason for that is, number one, if you just have these kind of pasted values lying around, you don't know what the source is of that often. You end up with these orphan values. And so you come back 3 weeks later, where do those values come from? So you always kind of need to know where those values come from. Secondly, you may want to change it. You might decide, okay, it's not the fourth value, I care about the third value. So then you change it to third. So the underlying data, so this would be, say, Bloomberg data, let's say random 1, random 2. We know the source is Bloomberg, it's random variable 1, random variable 2, then everything else is formulas. Yeah, so always use formulas to transfer, sort of, or you always use formula to refer to data. So never sort of paste values. And then the third rule is, when you're working with data, always chart the data. Always chart the data. Yeah. So, for example, if I download some data here from Bloomberg, this is a mistake lots of people make. They don't chart the data to see if there's any errors. So let's say I've just downloaded some data here from Bloomberg. So don't worry about how Bloomberg works. So let's do it back to 2010. So let's say I've downloaded all of this data, and let's say, so what I always do whenever I download any data, I always chart it. So, the short key you have to remember, if you press Shift and then move, it highlights the cell. Yeah. So Shift. So Shift, that's sort of this highlight. Okay, so I've sort of Shift right and then Shift Control down. I've highlighted everything. Then I insert the chart. So here's the chart, and I can see the chart. What I'm going to do is I'm going to change the axis. I double click on the left axis, and this comes up over here. I just change the axis options, the minimum to 1. So I can have a look at this. It kind of looks fine. There's no weird kind of things going on here. Now, let's say there was a bad value somewhere. So let's say, I'm going to just put a random value in. Let's say that was 20, When we look at the chart now, when you chart it, you'll see, look, there's a massive error here. So then there's a problem with your data. Like if you just look, if you didn't have the chart, you just wouldn't know there's a problem with the data. And by the way, I deleted that, then I undid that change. That's Control Z. So Control Z is undo. Undo. Okay, so always, so the more time series you have, you always have to chart it. So this is charting for errors. Okay, so that's kind of some basics. Is that clear for everyone so far? Yeah. Okay, cool. So now what we'll do is we'll do 2 exercises. which will use a sort of a bunch of different formulas. The first one is we'll build a trading rule, a momentum-based trading rule for, say, US equities. And we're going to use a bunch of different sort of formulas for that. So this is the sort of the trading rule. So I'm going to just download some data from Bloomberg, which will be the S&P 500. So again, don't worry about how I'm downloading the data. If you use Macrobond, you use your Macrobond. If you're using the internet, you can sort of download it from wherever your source is. So I'm going to just download this from, say, 1999 onwards. And so what I'm going to do, so this is the time series I have. So again, first of all, I'm going to just chart the data just to take a look at it all. So, okay, this is how it looks. It kind of, okay, there's no weird measures, but you can see, how the values work. So I'm going to just do Control X, which is cut. Oops. Cut. And I'm going to just, I press Control Up to jump to the top. I just want this to be somewhere at the top. So it'll just kind of stay over there somewhere. Now, what I'm going to do is I'm going to come up with a trading rule which says something like, I'm going to look at the rolling 1 month change in the S&P 500. Well, let's say the rolling 3 month change. And if the rolling 3 month change is positive, I buy the S&P. If it's negative, I sell the S&P. So what I'm going to first of all do is I'm going to freeze the frame. So if I press Alt Window F, that freezes the frame. That's kind of just another thing. So I'm going to go right to the end, Control down to go to the end. So 15th December, which is today. So there's different ways. I'm going to calculate the rolling. Let me do maybe the rolling 1 month, just to kind of make it a bit easier to see. So what I'm going to do is actually, yeah, a couple of things here. So one way is, okay, divided by a month earlier, which is kind of roughly over here, -1. So that's a 1 month change. And I'm going to just copy this formula all the way up. So now what I have is, this is just a rolling 1 month change. So every day on the 11th deck, it looks at the past month. Now, there's a couple of things to note here. One is if I press F2, it opens the formula up. So when I press F2, it allows you to work from the cell directly rather than having to go up there. And it also highlights the cells you're referring to. So you can see the blue is here, the red is there. So now you can see what cells you're referring to. That's when you hit F2. So let me just put that there. So F2 opens the cell. So we have that. Now I'm going to chart that again just to have a look at it. So okay, that it just tells you what month changes are fairly noisy, and that's kind of how it looks. So we're going to just put that back up there. Okay, so now we have the 1 month rolling change, and now what I'm going to do, I'm going to create a trading rule. So you always have to label things as well. So this is 1 month rolling change, and then the other thing is I'll put this into percentage changes so that you can sort of see it sort of clearly. Now I'm going to have my trading rule. My trading rule will say that if the percentage change is positive, I buy US equities. If it's negative, I sell US equities. So the rule will be, if that is more than 0, then I buy. So 1 is my buy. If it's negative, or else -1. So this is an if statement with the rule that you want. If it's more than, if it's true, you put 1, comma, -1. If it's false, it's -1. So this is the trading rule. So, and again, we can chart that to kind of have a look to see how that chart looks. So, I mean, it's jumping around a lot. So kind of, it's lots of buy sells everywhere. So we'll just put that up there. Now what we have to do is we have to work out the returns of that strategy. So first of all, what we do is, okay, how much does the daily returns of the index? So this is not the trading rule, but of the index. So every day, we're just doing a percentage change. So these are the daily changes. Sorry. These are the daily changes in the S&P 500. So now we're going to do the daily returns of the trading strategy. So now what we have to do is, okay, so we have a rule here. So yesterday at the close of business, the rule was to buy the stock market. And so you went long. We got the signal to buy last night. So we went long last night. And then this daily change here is the change from last night to the end of today. So you have to look at the long from the previous day. You're capturing this return. So this is your return here. So this is the returns of our strategy, our daily sort of strategy. Now what I'm going to do is I'm going to create an index, cumulative index returns. So let's get rid of the references are there because the percentage changes, the 1 month rolling was before the 1st of Jan, for which I have data. So what I'm going to do is, where we start to get data, I'm going to put 100. We start with $100. And then we do that. So that's just 1 plus the percentage change times the 100. You see, I'm not using the mouse right now. And so using this strategy, so like, we have this chart here. So this is the S&P 500. And then I'm going to duplicate this chart, Control D, which is duplicate. And so I'm going to now bring this over here. So this tells you, so the S&P 500 by itself, you see it goes up over time. Now this momentum rule, where if the S&P yesterday went up over the previous month, and I bought the S&P, you basically, this is your returns over time. You start with 100, you end up with 40 or 50. So this is quite a bad trading rule. But it doesn't matter if it's good or bad. This is just as a kind of an example of how that kind of works. Oh, sorry, Angela, go.
So I had a quick question about the -1 for selling. So when you sell, do you, and then, so if you sell it and then the price goes up the next day, is that a negative return for you?
If it's, let's have a look. So if we look at this one here, so this one here, it was a sell here, and then the next day S&P went down, so we made money. It's -1 times that, so we made money on that occasion. So it's so you do you end up capturing the opposite of whatever the market did that day. But what this strategy tells you is that because you've lost money a lot compared to this, this tells you that the times the model's telling you to sell, you're losing money most of the time, because it just isn't working. Okay, so now we're going to do a couple of little tricks here. So this is what we've shown here is you're moving around the spreadsheet with sort of shift, control, up, down, left, right, an if statement, and how to create a trading rule. That's all fine. You guys probably know that already. Now, let's say we wanted to go rather than 1 month, let's say we wanted 3 months or 6 month returns changes. What do we do then? One thing you could do is, okay, you could just manually sort of change the formula and go 2 months earlier. So now you have 3 months in total. But there's a better way to do that, which is to use the offset function. So I'm not sure if you guys know the offset one, which basically is that divided by offset. Now, what the offset does is it says, okay, pick your starting point. So my starting point will be this cell here. And then you can see here the reference, which is the starting point, then rows. How many rows down do you want to go, or up do you want to go? So I want to go up 20 rows because I want to go back to, I'm going to start here. I'm going to then kick it back 20 rows up, which will be a month before. Then how many columns across do I want to go? If it's plus, it will take it this way. If the columns are left, it will go this way. I want 0 because I want it to be the same column. And then height and width is if you want an array, which we'll do later. Okay, so basically what I've done is, see this formula here, I had 20 days earlier just manually. Now I've created this offset formula where now I have this minus 20, which says start here, and that cell has to be sort of moved up 20. If it's plus 20, it will go down. It will go down 20 rows. So we have that. Now, better still, you know, I've kind of put minus 20 in there, but let's create. What I do is I always highlight a cell as yellow if it's an input into a formula. So I'm going to put minus 20 here. And I'm going to change this to make it refer to this. Now, the thing you have to remember is I'm going to drag this formula up. So when you drag this formula up, it'll go H3, it'll then go to H2, H1. So you have to force it to remain still. And if you press F4, F4 toggles between the different options for keeping that cell reference still. So if there's a dollar sign, that means if you drag the formula up, the dollar keeps that reference the same. So if it's like this means if it's $3, if I drag my formula up, that $3 will always remain the same. If I drag it to the right, the H will change to I, to J, to K, and so on. So F4 that's an important one. So I'm going to just copy it there, and I'm going to take it all the way up. I'm going to change my trading rule to now refer to this one. And so this is the 1 month rolling change with the offset. So formulae used. So we're talking about offset here. Okay, so now if we have a look at the chart, let me find it again. I've lost my chart. Okay, what I'll do is, yeah, okay, I did it near the 100 mark. Okay, so remember this was the chart I had which showed the terrible returns. 100 went down to there. So let's say. So this is 20 days earlier, so it's 1 month change. Let's say we go to minus 40 days. Actually, one thing we'll have to do is, because this 100 will have to just change it further down, because we're going to start to use bigger look backs. Okay, so now let's say we go to minus 40. It's still not great. Let's change it to half a year, roughly 120 days. That looks better, you know. Let's go for 1 year, so minus 260. That looks a bit better as well, but still, again, it's not as good as the overall index. So you see, you know, what I've done here is, you know, I might ask one of you guys, okay, build me a trading rule. I want you to test 1 month, 3 months, 6 months, 12 months. You know, in the past, you would have kind of gone to here, then create another 12 month, another one. And now you can basically just have something where this thing up here, this cell allows you to change everything. Yeah, so that's kind of one thing, one important thing to note. Now, obviously, what this also tells you is that, you know, when you're working with data, and this is what lots of hedge funds do and quant funds do, you can data mine like crazy. You know, I could spend the whole day, you know, picking a certain value and find one like, you know, minus 112 might be the best return ever, you know, but it just could be spurious, might just be quite random, you know, based on that. So this also, there's a downfall to be able to do all of this type of stuff, because you could just come up with results that, you know, look great historically, but have no, you know, basis for working well in the future. Okay, so we've done the offset. Now let's say we say, okay, I'm only going to trade on Mondays now. So at the moment, my trading rule creates a trading signal every single day. So let's say I want to trade only on Mondays. Now, how would you build that into your model? So there's a formula called weekday. This returns, I'm now going to refer to the date. So it's gone to the date column. Actually, let me do a bit further out so you can see what it's referring to. So it's going to refer to that, and I press comma and then there's different, Excel has different ways of defining days. So for me, I want it to be such that Monday is number 1 and 7 is Sunday. So I'm going to click on that, which is 2 as it happens. So basically, if I put 1, then Sunday is 1, and so on. Whereas if you put 2, then Monday will be number 1. So I'm going to copy all this all the way up. So now you see, okay, number 2. So this is today, it's Tuesday. Number 1, that's Monday. 5, that means the 11th was a Friday, and so on. Yeah. So now I'm going to just introduce you another column here to say trading rule on certain day. Okay, so now this one trades every day. So now what I'm going to say is I'm only going to look at the 1 month returns on Mondays. So I have to create a formula. So what I'll say is if that is equal to 1, which is the Monday, then we take this signal here. I mean, you can do this in different ways. You could actually go here and say if that's more than, okay, we'll do that, actually make it easier. If that's more than 0, then you buy, otherwise you sell. If that is more than, okay, no, hang on. You have to have an if within there. So if that's a Monday, then if that's a 1, then 0. Otherwise, if it's not a Monday, which is the second part of the negative statement, then take the previous trading signal that we had. So you're not going to assess it on the previous day. So we do that. So actually, another thing to note is what you can also do is you can also go to conditional formatting, which is quite good, color scales. And then this allows you to visually see how the rules differ. So for example, here you see, this is the daily one. It's had a sell, buy, 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 buy. And then on a Friday, it went back to that. But if you see my one here, because these two were, this was on a Thursday, this was on a Friday, it doesn't change the signal. It only assesses a signal when you're on a Monday. So now we've changed, we've introduced that. And then we have the daily returns of our model. And so I'm going to just drag it across there. So I've just switched the reference for that. And then on top of that, what I'm going to do is, like I did before, this, I'm going to have something here again. And I'm going to put 1 there. So now I'm going to change this to there, F4, and copy this up. So so basically this is using, let's say we have minus 120 days, that's 6 months. If we trade on a Monday, every Monday, this is how the returns look. If we switch to Tuesday, this is how it looks. Wednesdays, this is how it looks. Friday, or Thursday, that's how it looks. And then Friday is how it looks. So it looks slightly different, based on different days. So that's kind of another way you can look at this as well. So what we've learned here is, the weekday formula, which is a very useful one. And then also, as you can see, what's really important when you're doing all of this is to think in logic terms. If this, then that. You have to always kind of think, what's the most elegant way I can have something where I only check, you know, I check what the trading will is on Monday, but if it's not Monday, then what value do I take? You just take the previous day's value. You have to make that logical leap in your head to understand what formula to use. So the more you kind of think in those logic terms, the more easily the formulas will come to you. Now, I mentioned weekdays. Now, another thing linked to weekdays is, let's say we have two dates. I'll pick, say, 12th Jan 2018. And then I have another one, which is like 13th August 2020. Let's say we want to work out how many business days were there between the two. So calendar days, I can just subtract the two. That's 944 calendar days. You know, that's all it is. If I want to know how many business days, there's a formula called net work days, where you put the start date and then you put the end date. It's 675 work days. Now, sometimes that's important because you're building a model and you want to know how long did a signal last, you know, or like the pandemic started on this day, ended on that day. How many work days was that? So you can use this as a formula. So that's another formula that's worth using. Okay, so go on, Angela.
Does that take into account holidays as well?
Well, there's no. It basically just looks at there's an option here where you can, if you put a 1, it will then use UK holidays or 2 US holidays and so on.
Gotcha.
Yeah. So, okay, so this is kind of, you can now, all of you guys can now build a trading model very effectively. The other thing I should mention is just basic formulas like averages and so on. So what I can do is I can look at the average daily return. So what I'll do is just average, open bracket, you know, I'm just picking the range there. My average daily return is whatever this is here, that long number. But if I multiply it by 260, it annualizes it. So it's 1.92% per year. Then if I want to calculate Sharpe ratio, so these are average annualized non-compounded returns, because I'm not looking at the compounding. Non-compounded returns. I want to work out the Sharpe ratio, which is returns divided by standard deviation, or more precisely, excess returns divided by standard deviation. But let's ignore the excess bit for a moment. But I need to calculate the standard deviation. So what I'm doing now is, to make things simple, F2 to open the formula up. I'm pressing Shift Home to highlight the entire formula. Control C to copy it. Escape to get out that cell. Go down one cell, press the down arrow. Control V, I pressed it there. So now I've copied that exact formula there. And now what I'm going to do is I'm going to calculate the standard deviation. And just from a mathematical perspective, if you annualize a standard deviation, you multiply it by the square root of the number of days you want to annualize by. It's just the maths of it all. So I times it by the square root of 260. So the volatility is 20% annualized, which is what you'd expect. So this is the annualized standard deviation. And then the Sharpe ratio is return divided by that. And let me just... And so the Sharpe ratio is 0.09, which is not very good. If I copy this same formula, Control C over here, now this I've copied it over to just the index by itself, just a buy and hold of the S&P is Sharpe of 0.34. So then we can also then look at this like minus 20, Sharpe ratio is minus 0.3, minus 260. Okay, it's doing that because where my 100 starts, it starts minus 160, and so whoops. It's doing that because the 100, the reference point goes above the cells. So I should do like 67, say, and so on. So you can kind of see what they are. Okay, so that's the trading rule. Now what we're going to do is we're going to look at correlations, and we're going to look at lookup type functions, which is another classic thing we have to do in research. So we're going to look at correlations. So what I'm going to do is I'm going to just download some FX markets, say, which will be so that's sterling, Swiss, Aussie, Kiwi, Noki, Stocky. Oops. So, okay, I'm going to just download all of these. There was an error there, which I'll just correct in a sec. Let's do it from 118. Okay, that was an error there, so let me just do that. Okay, have I missed any? I missed Canada. Okay. Okay, so now we have all of this data I've downloaded. Now you can see there's euro. This is more kind of an interesting formatting point. You could say, okay, look, I want to have a label at the top where I just want the currency code. I don't want the currency bit. So at the moment it says euro space currency. This is the formula left. Refer to the text, and then how many characters from the left do you want to include? So comma 3 there. Yeah, see, so it just takes the first 3 letters. If I put 4, if I put 5, it would have the C. If I took 6, then the U, and so on. Yeah, so this is good for labeling. So this is another one. So this is left, and there's right as well, and there's something called mid as well. So what mid does is it says you start at midpoint. You start 3 letters in, and then you add, then you have 3 more letters. Now you could say, actually, look, some of these are in lowercase, some are in uppercase. I want everything in uppercase. There's another formula called upper. Open bracket, close bracket, upper. So now that looks nice and neat. And there's lower is the other way around. So this is important because, you know, we're formatting charts. You just want everything to be quick and efficient. You know, if I'd asked you to do this, you might manually copy pasted, there'll be an error somewhere. And, you know, let's say I change the formula here, then you'd have to manually change the top. You want everything as formula driven as possible. Now what I'm going to do is I'm going to calculate some correlations between all of these different things. So I'm going to look at, yeah, let me just keep it very simple, actually. We won't look at correlation of changes. We'll just look at correlations with the euro. So what we're going to do is we're going to look at the correlation of the euro at the moment, which is here. Let's say over the entire sample period there, with the yen. So over the entire sample period. Now, there's an issue with currency quotation here, just to confuse things, because euro is quoted euro dollar, whereas yen is yen dollar. So what I'm going to do is I'm going to actually change it so they're all quoted in the same direction. If you followed last week's lesson, you'll understand what I'm doing here. And now see, there's this problem here where this is saying it's dollar and it's really euro. So what I'm going to do is I'm going to change this to the mid formula and go for 3-3. Whoops, 4-3 there. Okay, so there's there's an 18% correlation between. So we're looking at the correlation of FX versus the euro. That's what we're doing. Okay, so now let me see what the sterling one is. But remember, what's happened now is the formula. I pressed F2 just now. It's gone sterling to yen. So that's a problem. It's the euro I wanted. So I go back to this formula, hit F2 to open it up. Then I've got to make sure that the column doesn't change. So I'm going to go to F, put $1 in front of those. So when I copy it across, it stays with the euro. So sterling has a 81% correlation, and I'm going to copy it all the way across. Swiss has a 49%, so Aussie dollar 88%, 83%, you know, and so on. So those are how the correlations look. Now you could say, you know, what I've done is I've looked at the correlation over the entire sample. Let's say I wanted the correlation over the latest 3 months, or let's say the latest 20 days, yeah, like we did before. I'm going to freeze the frames again, because I'm going to go to the bottom again, and so I'll do the correlation, and then do 20 days, which 20 would be, I think that's about right. So correlation of that with that, and I have to put the $ here next to the F, which is the euro bit. So this tells you that over the last month, the correlation was, you know, was whatever this is, yeah. But now, let's say I now wanted to look at 40-day correlation. You can now use the offset again. So if I go back, F2, open it up, I can use the offset again for all of this. So the way this would work is offset the reference point here. I don't want to go up or across. I want to use the height and the width. The height and the width rule there. So that will be -20 and the width of 1. See, I can use the offset there. So basically, if the offset has this height and width thing, which is an array, basically. So what I've done is I've said, okay, stay here. And the height I want is -20, which takes you that way rather than down. So it'll highlight all of this up here. And the width is 1, just 1 cell. I don't want you to go across here. So that's what I've done. So I can also do the same for the other one. For the F1. So I put $F, and we see we get the same results as the one above. Now what I can do is I can put this there, and then put that there, F4, F4. And let me just get the formatting right. See, exactly the same. So now I can change it to -40, so 2-month correlation. The most recent 2 months. I can do the 500-day correlation. You know, I can do the 1,000-day correlation. Whoops, I haven't got enough data points for that. See, so we're using the offset function again, but this time we're using it to capture an array. Okay, so that's how a different way you can use the offset function. Use as an array as well. The correlations worksheet. Okay, so now what I'm going to do is I'm going to create a table. So the way I'm going to do that is I'm going to, first of all, create rank. I'm going to rank this. So it's basically, I want to create a table which will show me the highest, most correlated currency at the top and the lowest correlated at the bottom. So first I select this, the rank formula is the thing you're trying to rank, and then you select the range over which you're comparing it to. And then I copy that across. So 96.6 is the highest ranked, which is what you want, and the lowest ranked is the yen at that one. Now I need to create a table. So this is where we start to get into the lookup sort of functions, or the index match function. So I'm going to, have my ranking. So 1 to 8. I'm going to have the name of the currency here and the correlation here. So now the formula is index what this does is that it basically says which row or column of values are you interested in taking something from. So I want to take the values from here, the fx1. Then it will ask which row do you want in relation to this. Because this is only one row, the row number will be 0. Oh, sorry. Yeah, the row number will be 0. Now I use a match function, which is to say that, you know, the column will depend on whichever one's ranked number 1. So what I want is this one here. So that means the column could vary depending on this value. So what the match does is it says, okay, what is the value you're trying to find along a row? It's this one here. Comma, what's the lookup array? It's this one here. And then the match should be 0. So it comes up with stocky. So what this index does is that the index kind of is almost like coordinates. It says, okay, this is the array you want to get your value from. What coordinate do you want? You want effectively row 0, as in it's only one line, but you want to capture this one here. Now, to capture this one here, you need the formula to know that this is 1, 2, 3, 4, 5, 6, 7 across. So the match function does that. What the match says is, okay, you want to match 1 within an array, and it will come back with the number of columns that the number 1 is in, which is 7. So if I take that out, the match is 7. So what the formula is saying is index, stay on the same row, 0, so 0 rows away from that, and go 7 across, and that's that one there. Now, if I go here, it's got an NA, and the reason it's got an NA because the array here, I didn't fix the array. So I'm going to fix the arrays so that when I move it down, it doesn't drag all the formulas down. So now you see stocky comes up on top. So now what I'm going to do is I'm going to just copy the formulas across. Now it's the correlation I'm interested in. So I'm going to just drag this up because now I just want the values from here. Hit enter, and now copy this down here. So now I have the table, and you know if I was to change the rank to this one here where I'm changing all the values all the time, see this will start to change. So let's say if it's minus 100, it changes. Minus 50, it changes. So that's how we kind of do that one. And then you can kind of do some formatting sort of points where you kind of make this a white background. You know, you put some nice underline thing there. And then you can copy paste this and sort of put this into whatever document you have. So any questions around that? No? Okay, cool. Okay, so let me just write that down. So what we've used there is we've used rank, and we've used index, and we've used match. Okay, so I think that's probably enough, I think, that I wanted to talk about. So maybe if you guys ask any questions for anything that you've always wanted to ask.
Just one thing which I've come across, which got me stuck on a number of occasions, was when I was looking at the COVID stuff. COVID data comes out on a daily basis, whereas stock market data comes out on a weekday basis. And often when I was looking at the correlations, I couldn't just take the two columns because then they wouldn't overlap. You'd have too many data points in the COVID stuff, which has the weekends. I was just wondering how you can link the two up nice and quickly.
Yeah. Did you find a solution yourself, or?
I always forget, and yeah, I think I can. I've played around with it, but yeah, I can't.
I think the best way is just use IndexMatch with the dates. So I'll give you an example. So this is matching business days with calendar cal. Okay, cal is, there's a limit to how long it can go. So what I'll do is I'll download 2 time series. One will be euro, say, and then this will be okay, calendar default. So this will just be business days. Oops, let me just put the start date as 2019. Okay, so this is just normal business days. And then what I'll do is I'll pick another market here. Actually, no, let me actually do the thing. So what I'll do here is there any market that's open on Saturdays? Probably like Saudi Riyal or something. Let's do the Saudi Riyal.
Or a commodity.
Sorry?
A commodity might be open on.
Yeah, that will depend on the exchanges. So if the CME. So what I'll do now is I'm going to change this. There's an option in Excel where you can sort of pick, in Bloomberg, where you can pick calendar days. Let's have a look where it is. Business day, no holiday, Sunday to Thursday. Let's do this like Sunday to Thursday. So these should be a different set of dates. Yeah, so you can see here 14th, 17th, 18th. So these are, I guess, the Middle East sort of time. 24th, which one this one doesn't have. So now what you want to match this back with this. You use IndexMatch. So basically you say index. You want to get the values from here. You're with calendar days, you'll end up having a lot more days, you know, there.
Yeah.
Actually, let me see if I can do calendar. I'm just guessing, is it 7 day? Oh yeah, yeah. So this is calendar. This is, yeah. So it's way more now. Yeah, I just kind of guessed that, but okay. So you go to index, the array there. Then it's match, because we're trying to work out which row it should go down. We're going to look up this value here, and we're going to look it up in this array here F4, and we want a precise value, and then 0, because we don't want to go across. So now it's kind of matched it up. So we can just check. So 15th is 3.18th. Yeah, it's kind of matched up. It's matched up fine, because if you look at that one is the same. That one's the same. So you just use the index match to kind of match it with the dates.
Brilliant. Thanks.
Yeah.
It's just, I mean, Bilal, I always use VLOOKUP, but I guess this is slightly better now.
Yeah, I used to use VLOOKUP a lot, but actually IndexMatch is more efficient. It's quicker, and it's more precise, because the problem with the VLOOKUP is that when you start to introduce rows and columns, it messes everything up. So this one here, you know, I've got this table. If you use the VLOOKUP, you'd have a problem if I inserted a row here. A VLOOKUP would have a problem then, because you've now expanded the array in a VLOOKUP, and then you have to change the count, you know, that you have to sort of change that manually, whereas IndexMatch doesn't have that problem.
Yeah, you don't do 2, 3, 4, 5. It's just going to point to that column where you want
exactly.
it to go. Yeah.
So
That's very good to know.
Yeah. So you can look at this like, so we do H lookup, which could be the other way, lookup value is 1, and then so that's that one and that, and then we say it is so H lookup is 4. That's 8 rows down, 0. Yeah. So look, we're looking at H lookup here. Now the problem is if I insert a row here now, you have a problem because now see it's all gone to 0. It's because the array's increased, and now it's like nine rows from the top. So I have to manually come and change it. So it just gets more complicated to get around with lookups. Then you have to have like a counter on the side. I used to do a lot of that in the past, but you realize that index match just gets, sidesteps that issue.
Is there a function that shows so for example, the dates and entire sample, if you find out if you
you're a bit faint. You say finding dates where?
the
I can't hear you that well. Can anyone, Sam, can you hear her? Or
no,
cells in between them? Is there a function that?
Can you repeat yourself
fine.
again? Just try one more time. Can you say it again? You froze.
Is this better now?
Yeah, it's better. Yeah.
Okay. Sorry about that. So let's say if you want to find the number of cells between entire sample, so E4, and then just the word dates on E14. So is there a function you can use to show you how many what the position difference is between those two cells?
That's a good question. So you want to see what is the gap between that cell and that cell?
Yeah.
Yeah, I mean, I'm not sure actually. That's a good question. What I'm thinking is if there's no values inside there, my first instinct would say you use count. Yeah, if you use count, it'll just count how many cells there are. But if you have blanks, if you have a blank, it only counts values. It doesn't count text, so you have a problem there.
You can do count A, it will count text as well.
Yeah, does it count blanks as well or not?
Yeah, I think so. So try that. Yeah.
Have a look. No, maybe there's another count. Yeah,
count blank. Yeah.
Oops. Oh no, maybe not. Count blank. Oh, it's just counting the blanks now. But there's some version of count that will work. That will do it for you. I'm not sure which one it is. Count. Yeah, but I'm not sure which one it is. But one of the counts will do it for you. The final thing I just wanted to maybe show is how to use an array inside a formula. I'm not sure if you guys do that. So let's say you wanted to say that I want to know what was the average of dollar Swiss, this column here, whenever dollar yen was above 110, say. So you could say, okay, my formula could be if that is more than 110, give me the average value of dollar Swiss whenever dollar yen is above 110. So this is what I'm going to try to do. And it comes out with this error. Yeah. Yeah. So what you have to do then is you kind of have to change it around. So you start with average. So now you have the average. You have an if in there where you say, okay, that is more than 110. And then you pick, if that was more than 110, then you go to this. If it's more than 110, you go here. Otherwise, it's kind of a NA, not available or something. So you can basically do that. Yeah. So it's basically rearranging the formula so that you have to think about, okay, it's average I'm looking at, and then you pick the array, mod 110, and then the array you want to match it with. And what it will do is it will only look, it will only bring the values in that array that are above 110. So then if we kind of change the thing here, 110 to here. So if we do like 105, it changes. See, 100 changes. Let me pick Aussie. Maybe it might be a bit more interesting. 110. Yeah. See, you see it changes now. So basically, this is a really useful formula because you kind of say that, okay, if interest rates go above 1%, what is the average level of euro? You can kind of use that in this formula as well. So,
do you ever use the Control-Shift-Enter for the?
Yeah. I mean, if you do Control-Shift-Enter, it comes with the same results. Yeah, like in the past, in older versions of Excel, you had to do Control-Shift-Enter, but for some reason now you don't need to for the array formula. Yeah. So formulas you can use arrays within if statements.